Broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2020 webinar series. This year's webinar series will focus on the whys of insurance. LLIS offers many insurance solutions for fee-only advisors and their clients, and we understand with many options come many questions. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them and typing them in the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter is knowledgeable in a wide range of solutions. He is constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendations. In 2003, he joined LLIS, earned his CFP designation in 2006, and assumed the reins in 2012 as president and CEO. Here to talk all about life insurance is Mark Maurer.
Thank you, Claudia. Hi, everybody, and welcome to our September webinar. And since you all may not be on near as many insurance blast email lists as I am, September is Life Insurance Awareness Month. And so it's a good time to talk about life insurance and really just to remember what life insurance can do. We're talking about the whys of life insurance. This is part one, so we're going to talk about term and sort of life insurance in general, and then next month we'll delve a little bit deeper. Like I said, today we're going to talk about term insurance. Why term insurance? Why permanent life insurance? Seems like maybe you can always use term, but there are times when permanent insurance is going to be a better fit. And hybrid life long-term care policies. Why that one would we look into it? So we're going to talk into some whys, but why life insurance, regardless of term, permanent, hybrid? Why life insurance? Well, the answer is because we want to leave money at death to someone. That's what life insurance does. It doesn't keep us from getting sick. It doesn't keep us from dying any more than health insurance keeps us from getting sick. But if something were to happen to us and there's a financial loss to someone at our death, then life insurance steps in and can help offset those what might be catastrophic financial losses to a family, to an estate, all of those different things. So why life insurance? Because there's a reason to leave money to someone at my death. Very basic. Like I said, the why is simple. Now there's lots of factors under that why, but the why is there's a reason to leave money to someone at my death. So we're going to talk about some who's, some what's, some where's, some when's, maybe a how. It's always thrown in there with the other W's, but we're going to talk about the whys and then some of the other W words. So who can get life insurance? Well, it's a person, and it must be a living person. Doesn't seem all that hard. In order to buy life insurance, you must be alive and you must be a person. Now, you can have trusts and other entities own a policy, but life insurance must be on a person who is alive. And the easiest people to get life insurance on are US citizens. A close second would be green card holders or permanent residents. So people who have strong ties to the United States. But we can also insure many visa holders. And I'm not talking about Visa like the credit card, like a MasterCard or American Express. Visa, meaning someone who's here temporarily. And there are lots of different types of visas, more than I think I could come up with off the top of my head. Some are permanent, some are temporary, some are very temporary. Some are based on your particular type of occupation. So there's a lot of visas. And for the most part, insurance companies are, some companies are, there's almost, for any type of visa, there's almost always an insurance company who may be willing to cover that person. Now, like I said, some are very temporary, and so the insurance companies are wondering why life insurance in this country if there's no real strong tie to the United States. I'm working with an advisor and a client right now. He's been in the US for the last 8 years on a visa. He's in software developing and has been working here, owns a house, but his visa is coming due at the end of October. He's in the process of renewing it, but it's not approved yet. And so we looked at life insurance for him. 2 companies that I talked to said, no problem. Based on the track history, it looks like he's going to stay here for a while. 2 of them said, not right yet because it's not been approved, but once he's approved, let us know and then we could consider. So just lots of moving parts there when it comes to something like a visa. Where? Well, you need to be in the United States to get the policy. So if you have clients who are living overseas and have no plans of coming back to the United States anytime soon, they might need to look at life insurance over there. Insurance companies are regulated by the state, so the contract that every insured signs is a life insurance contract that's based on state laws. And so for each state, the insurance companies want the person to be in the United States in that particular state or when they sign the application and at delivery. So if you have clients who are overseas, most of the time, it's possible to get coverage as long as they come back to the US on a regular basis. It's much easier if they're US citizens and they have a residence, ties, bank accounts, lots of reasons why we'd look at life insurance here as compared to where they are 10 or 11 months out of the year. And then we look at the what. What is the life insurance going to protect? And so because we're talking about term first, the number one thing that we look at is income. Because term doesn't go on for forever. We use term life insurance as a way to replace income if something were to happen to that income earner before retirement. So a lot of times we base the amount of coverage off of someone's income. The reason is, what are we going to do with that income? Well, we're going to pay down the mortgage. All of these things are built into our income. Kids, they're cute but expensive. And at least initially, kids are just a drain. They're just a cash flow out. They don't work. They don't bring anything in. So kids are expensive when they're young. And I think even when they get older, they're probably more expensive. But that's something that if we don't have the income coming in, how do we pay for soccer uniforms and cleats or ballet lessons, piano lessons, food, college savings? Without income coming into the left-hand pocket, how do we put something away for college in the right-hand pocket? That income is paying, coming into the family unit and being used to pay for all of these things. And then, of course, once we've done taking care of the kids and everything else we can think of, if there's anything left over, then we start to think about ourselves. Now, you all are working with your clients, and so I'm sure they're better than the average person about making sure they're saving for retirement. But sometimes we think of it that way. We always say, pay yourself first. Sometimes we might think about it, pay ourselves last as the kids are taken care of, after the kids are taken care of. But again, how do we save for retirement? We have to have income coming in order to do that. Because if there's no income, how do you pay the mortgage? How do you save for college? How do you have anything to pay for retirement, to save for retirement? That's what life insurance can do. That's the why. If there's no income, why do I need life insurance? To have money to be able to pay for all of these things. So there's our why again. And just a thought on mortgages. Mortgages are historically low rates, so you may have clients who are using right now, if their incomes are steady, using this opportunity to buy their first home or maybe trade up on their homes because they have, you know, the ability to, maybe buy a little bit bigger house than they thought because the rates are so low. Term life insurance is a great way for clients to protect their families, even each other. So you may have young clients, and premiums are always going to be lower the younger someone is. But you may have young clients who don't have kids, who don't have, a lot of the expectations on income yet, like college savings and kids that are expensive. But you may have a husband and wife, they're starting off, but they're getting their first mortgage, they're getting their first house. You can use a very basic term life insurance policy to make sure that in case something happened to either one of them, then there's the life insurance death benefit so that the survivor could pay off that mortgage, not have that debt, and be able to move on financially. You can match the life insurance to the amount and term of the mortgage. That just makes sense. And lower interest rates on the mortgages may leave more room in their budget to purchase that life insurance. So not just a mortgage with a house that's backing it up, but if you wanted the spouse to be able to pay off the mortgage and stay in that house, have one less thing to worry about, then your younger clients with their first home can get the life insurance as well as that mortgage potentially. So the what? Another what? It's term life insurance. Why term life insurance? Because it can be designed for a specified amount of time. 10, 15, 20, 25, 30 years are common. Some companies started offering a 35 or a 40-year term policy because clients are working with you all at earlier and earlier ages. People aren't just starting to talk to financial advisors when they're in their 50s and have some money and are looking at retirement. They're working with you all much earlier and looking at how do I make sure I'm covered to 65 or 70, even if I'm starting off when I'm 30. So longer term periods. Again, the number one reason, replace income that's coming in to be able to pay for all of those things going out that are building that financial plan and building that financial house year by year. But a neat thing we can do is we can tailor the life insurance amounts to different life events or needs that all of that income pays for. You may retire at 65. The mortgage may be paid off, may be expected to pay off by 60. College funding paid off by 55. Kids can drive at 50. So may not need near as much life insurance in 20 years as you would today. So we're going to look at a way that we can tailor the life insurance to different client situations. So now we're going to talk about the who. Oh, how'd that get in there? Claudia, I'm going to have to speak with Claudia about this. The who. So I've been working in my house for the last 6 months. I gotta take my laughs where I can get them. So here's Roger. He's age 32. He's met with his financial planner, and the financial planner says, Roger, you're doing well. You've got this rock and roll band that, we think you're going to go somewhere with it. You're making a pretty good income. And so, to be able to take care of the family and all of your responsibilities, you need $3 million of life insurance. And because you're 32, hopefully you can retire somewhere in your early 60s. So 30-year term gets you to age 62. You need $3 million really today. We think the need is about the next 30 years. So let's look at a $3 million 30-year term policy. And Roger says, great. Why is term so great? It's low cost. Because we're only covering a certain amount of time, not for the rest of my life or Roger's life, but only the short term or even medium term, it's going to have a lower cost than other types of life insurance. And it's term, so it doesn't build cash value, so you're not adding extra premiums to build up cash values either. It has a fixed premium. Like I said, we can lock a level premium up to even 40 years now. So you know exactly what the premium is going to be, and we know exactly what the death benefit is going to be. How many bills do we get that we know exactly what all parts of it are going to be? My cell phone bill changes every month. The amount of it changes every month. The things that are in it seem to change every month. So to know my premium is this for the next 30 years, and if I die, somebody gets $3 million and have that fixed for the next 3 decades is pretty cool to be able to do. And you can convert it. So what's conversion? Conversion allows you to exchange your term policy for permanent life insurance without having to go through medical underwriting. So if Roger's in good health when he gets this term policy, for the full term period of however long he gets this coverage, he has the ability to go to the insurance company and say, I want to trade my term policy for a permanent policy. And they'll say, great, you were issued at a preferred rate 8 years ago. We're going to issue a new policy at a preferred rate class based on whatever age you are today. So if he was 32 and converts it 8 years later, age 40, the new permanent policy is the same as a 40-year-old preferred male today. No medical questions, no financial underwriting. So if nothing else, he's got that in his back pocket to be able to say, I think I need this all 30 years. I think that's going to work out well, but just in case I need it longer, I can renew this policy, no health questions asked, no matter what my health changes might be. What's it going to cost? Well, when you look at different factors, those are going to impact the premiums. So the younger someone is, the lower the costs are going to be. The healthier someone is, the lower the costs are going to be. Good health habits. And the shorter the term period, the lower the cost is going to be. So if you take someone age 30 and look at a 10-year term policy, I always say the last year of the term period is going to dictate the costs. So if you have a 30-year-old and he looks at a 10-year term policy, he's going to have a premium that's going to cover him between 30 and 40. Compare it to a 30-year term policy. You're going to have a 30-year-old who's covered between 30 and 60. So what are the chances? The chances of him dying between age 30 and 40 are going to be much lower than between 30 and 60. Imagine a 40-year term policy. He was 30, it covers him all the way out to age 70. So, you know, I can't think of anybody who I've known well who's died before age 40, but I can think of people who haven't made it to 60 or haven't made it to 70. So it's that last year. How old are you going to be at the last year of the term period that really starts to make a difference in the costs? When's the same policy going to cost more? Well, for someone who's older, they're less healthy, maybe they smoke, and like I said, the long-term period. So long-term period is going to have a higher premium, all things being equal, than a shorter-term period. Female rates, about 15% less than men. Why? Because on average, women live longer than men. So two man and woman, both age 50, if you look at a 20-year term, it's more likely that he's not going to make it to 70 than her. Smokers, anywhere 2 to 3 times the non-smoker premiums. So that's going to be a really, really big factor when it comes to everything. So we're going to look at Roger again here. So he's 32. got awesome sideburns. And at preferred rates, a $3 million 30-year term policy is going to cost them about $2,400 a year, $200 a month. So that's our starting place. And that may be great. That may be a great option. But we wanted to look at maybe what's another idea. Remember, I talked about tailoring the policy to different life events. So I like to look at term layers, because some things are just better than with layers. Lasagna, those noodles, meat, cheese, sauce. I mean, if you can't come up with a better layer, I don't know. I just don't know a better layer. Delicious. My mouth is watering. Kind of wish I wouldn't have used this slide. Paint. As someone who's going through a little bit of house remodel and just general all of that, because what else do we do with our time with COVID but paint things, paint walls, try out different colors. You put down a layer of primer and then you put down a layer of color. It works better because that primer makes it, I guess, stickier, and it takes out the color that's under it so you don't have to paint it as many times. Layering works with paint. Clothes, to get just the right warmth. We're in Tampa, Florida. I don't really understand what's going on in this picture. Just doesn't make sense to me. Somebody might be able to explain it to me sometime later. Just not sure. If we're cold, we put on socks. So, but you can layer for just the right amount of warmth. Or you layer delicious phyllo dough, honey, nuts, and you make baklava. Again, I kind of wish we wouldn't have used slides that had so much good-looking food, because I'm really hungry. But I digress. With layers, why do we look at layers? Because if we look at today, everyone's today is the furthest out from retirement. It just is, because retirement is going to happen at some day in the future. But the closer we get to it, the less we need. So today is when we're furthest from retirement. And if something were to happen, your client, has the most or highest amount of potential future income. So the loss is largest today if they were to die to the family unit and have the largest loss of potential future income. So the life insurance needed is the most today. But as time goes on and they earn their income, every year that goes by, there's a year of income under their belts, and one more year of mortgage payments, and one more year of 529 contributions, one more year of 401k contributions. And the retirement date doesn't change. Just if I'm from 10 years from now, my retirement date didn't move out 10 years. My retirement date stayed the same. So I've got 10 years less of working years, 10 years less of potential income. So as I get closer to retirement / financial independence, the amount of life insurance needed decreases. So that's what we can do with some term layers. We can get Uncle Pennybags, which is actually his name, Uncle Pennybags, from point A to point B with that life insurance, and having it a tiered, a layered, a decreasing amount of coverage. So let's look at a 3-term layer. Another delicious layer is cake. So we have our first layer, our topper, which is $1 million 15-year term policy. So let's say that Roger's kids, 1 or 2 of them, are pretty young, but in 15 years, somebody can drive. That means somebody can get other kids to school. The surviving spouse isn't responsible for every conceivable thing. So 15 years, somebody can drive. So there's $1 million 15-year term need. Within 20 years, everybody's into college, maybe even some are out of college. So we have a college funding need. that's $1 million. And that goes away in 20 years because in 20 years, either college should have already been saved for or everybody's out. So at that point, we had income coming in or we had the life insurance to be able to fill in that gap. And then, of course, like I said, we save ourselves for last, whatever's left over. And then this $1 million 30-year layer to cover a mortgage, make sure the mortgage is getting paid off, to retirement age, make sure that's shored up just in case something happened to Roger before he could finish all of his tours. And so you have this 3-term layer. So what do they have? They still have $3 million. Roger's insured for the same $3 million, but instead of all 30 years, he's insured for the first 15 years. And then, like Uncle Pennybags, riding his little car down towards retirement, we have these layers. So $3 million for the first 15 years. Why is this interesting? Well, A, it's pretty neat from just a academic standpoint, but clients don't care about that. Some of you may care about that, but everybody cares about the fact that it costs $1,700 instead of $2,400. So a savings of $660 per year initially. That's the aha moment here with this. Additionally, so not only does it save $660 compared to one big term policy, when the layers drop off, in 15 years, that first layer is going to drop off. So instead of $1,735, he's going to be paying $1,355 for 5 more years. And then instead of the higher numbers, he's only paying $840 for 10 more years. Because at that point, he has $2 million less of life insurance, but he has 20 years of income behind him. So he should be 20 years closer to retirement. So it saves money right away, and then it saves money later on, even more later on, as the layers drop off. And then eventually, all the layers are gone because they've made it to retirement. And this could look like Florida. Nothing says retirement like sitting by your pool, drinking fruity drinks and laughing. So after all of that, nothing happened with the life insurance. He didn't need the life insurance. He lived, was able to work for those 30 years and get to this point. So moving on, now we're going to look at a new when. Oh, one question. Rather than layer term policies, can you just modify a larger policy to reduce the benefit over time? What is the benefit of layering over just adjusting the policy over time? So that's a good question. Anytime you try to reduce a term life insurance policy, it is a request to the insurance company. So it is not a contractual right built into most term policies. Some companies just don't allow it, but most of them will do it most of the time. However, they're going to have some rules about maybe you can only reduce it once over the course of the policy, or maybe you can't reduce it within the first 5 years, or can't reduce it below 50% of the original benefit. So one is that you can't always be sure that the reduction is going to be allowed. Even if somebody today says, sure, we allow that, it's not a contractual right built into most term policies. The other part is that you would start off paying premiums like the $3 million 30 years. So he'd still have been paying the $2,400 for the first 15 years and then reducing it. So at least for the first 15 years, there wouldn't have been that $660 savings. So that would be another reason. So right away, it wouldn't. You may be able to reduce it later on, but you're not going to get that cost savings like you would with the term layer 2. Good question. Thank you. So when? We talked about term coverage, but then we have our next when. Remember I said it can cover, the term policy can cover up to the next 40 years potentially. That seems like a really long time to me. 4 decades, you know, just seems like you don't ever really need anything more than term. But what if the when is not if something happens in the next X number of years, but what if it's my lifetime? And given that I think I'm in pretty good health, but I don't think I'm going to live to my 125th birthday, there are still going to be times where a term policy isn't going to be long enough. It might be, but we can't be sure that it's going to be long enough. So when the when is my lifetime, then term isn't going to cut it. So we start looking at permanent life insurance. And so this would, to the last question, actually would be flexible. So you can actually design different premiums. You can actually reduce the coverage at different points in time, depending on the policy type. But so we look at permanent insurance when the when isn't a specified cutoff year, but rather for my lifetime. So why? Why would my when be lifetime as compared to term? Well, estate planning. Notice I didn't say estate tax planning, just estate planning. Everybody is doing estate planning, whether it's called that formally or whether the estate plan is just a will. If the estate plan is just to die intestate and assume that somebody's going to figure it out, that is an estate plan. Estate planning is just the plan for what happens to my stuff when I die. Now, hopefully you all are working with your clients a little bit more sophisticated than just my stuff goes here. But some clients are going to want to say, I'd like to make sure we leave our kids $500,000, $250,000. And life insurance is a great way to be able to do that because of some of the things I mentioned with the term insurance. It's a specified amount. To say I'm going to leave the kids the IRA, that might have been great in February, not so great in March. So what's the value? It's in flux. So life insurance can be a neat thing to leave because it has a defined amount. Estate tax planning, well, we got to throw that in there. Given that today with the $22 million joint combined estate tax numbers, a lot of clients don't have estate tax planning issues. But a lot of them who may have some wealth still have an estate plan. Whether or not they've formalized it and said, here's what I plan to do, not doing anything is still a plan. So estate planning is where sometimes life insurance can come in. Or special needs planning. When we talk about life insurance, work with a number of advisors and their clients over the years where we look at term life insurance to replace income. So if one parent were to pass away and the surviving spouse, parent, has that income to replace that income. But the concern is not, but then there's a second concern about what happens if both parents are gone. Now, we as parents are going to do a lot of things for free for our kids. At the point where we have to hire somebody to do these things, it can be very expensive. $60,000 additional a year, $100,000 a year. So we may have a situation where we use term life insurance to replace income, but then a survivorship or permanent life insurance policy that says even when the parents pass away, that special needs child is 20, 30 years younger than the parents, and they're still going to need care for potentially decades that the parents were doing, quote unquote, for free. So special needs planning can be a situation where permanent insurance takes over. Who should we insure? Should we insure one parent? That's an option. Maybe one parent is the driver of everything. One parent might be uninsurable, so we can only cover one parent. Both parents separately. Should we look at individual life insurance parent policies on mom and dad? Should we look at a survivorship policy? So covering both parents on one policy. So all questions that I'd worked with an advisor last week on with his clients, and so looked at that as an option for these clients. So Art and Judy have 4 kids: Joan, Jimmy, Jack, and Jenny. They're starting to look at estate planning. It's not necessarily an estate tax need, although a little bit of that's going to come into play here about just ways to structure it. But today they don't have a taxable estate issue. So that's not the reason they're doing it. They're doing it from a standpoint of they want to make sure that they leave each of their kids $500,000. That is a stated goal for them. And when I did the Zoom call with them, Judy said something I thought was interesting. She said, we're at a point where we really want to compartmentalize all of this. So rather than having things go on for a while or not being sure of what we want to do, we want to get this part of our lives set up, know it's there, so that we can move on to addressing something else. And so I like that compartmentalize. Our goal is to leave our kids $500,000. There we go. So how do we do that? We started looking at life insurance. So they have other assets, no debt, might leave their kids some other assets, but want at a minimum that $500,000 to each kid. So they asked the question, I talked about individual life insurance, survivorship, or second to die life insurance. And they said, one thing we'd like to take a look at is maybe we'd like to leave some money when the first parent dies. And Art is older. Judy, she told me her family tends to live into their 90s. So we're just going to assume that that's going to be Art, because he's 6 years older than Judy. She has some longevity in her family. So the idea would be that when one parent dies, the kids each get $250,000. So 25% of $1 million. And then when the second parent dies, then they get the second half of that, or the second 250, round 2. So then what do we do? How do we do that? With $2 million of life insurance, so 2 million divided by 4 gives everybody $500,000, and $1 million of life insurance on each parent. So when we price that out, just assuming they're both standard non-smoker rates, $1 million lifetime no lapse guarantee universal life policy for Judy. There are a lot of words there, but this particular policy design says, regardless of the cash values on the policy, it's a premium-based test. As long as she pays $44,798 for 9 years, it guarantees $1 million death benefit for her lifetime to her kids. And we looked at $1 million policy on Art. Remember, he's older. Male rates are higher than females. So in this case, $74,680 for 9 years. I know what you're saying. That's a lot more than a 15% increase. You're right, because now we're talking permanent coverage instead of term coverage. So between those two policies, $2 million for the kids, $119,000 on a 9-pay basis. Then we talked about, what about both parents jointly? Rather than some when Art passes away, some when Judy passes away, what if we make one policy, one big $2 million survivorship or second to die policy? It's going to insure both spouses. One policy, 2 people, as compared to 2 policies on 2 policies. So we already talked about 2 policies on 1 person, or I guess 2 policies on 2 people. This is 1 policy on 2 people. $2 million total either way. So survivorship policy is going to insure both spouses, but the money isn't going to pass on until the second death. And while we talked about this idea, they just weren't sure about this one, because if Judy does live into her 90s, like her family has done, they said our kids will basically be retired by the time they might inherit any of this money. So is there how do we quantify the difference in these two? Somebody asked, is there an upper age limit where someone could buy these 9-pay permanent policies? Right now, most insurance companies have put in guidelines to say once you're over age 70, you're depending on the health class. With COVID, some companies have underwriting 70 and older that are different, but for the most part, up to 75, maybe even 80, you could still be eligible for these policies. There's just some different COVID underwriting rules right now that are different than normal. So both parents jointly, $2 million policy, $109,000 6-pay. So if you're looking at the numbers, it's a lower amount and lower number of years. Why did we do a 6 or 9-pay? Because I said, let's use the annual gifting. $15,000 a year times 4 kids times 2 parents gives us about $120,000. So that's our annual, using the annual gift exemption, $120,000. I said they don't necessarily have an estate tax problem, but if there's a way to move it out of their taxable estate just in case things change, that's always a good idea. Is there any way to use IRA money to buy something like this? I guess yes, you would actually have to take money out of the IRA, pay the taxes to buy the premium. So no cool way to avoid taxes on that, unfortunately. I love the idea though. That would be fantastic. Write your senator. Or one survivorship policy. So keeping under that $120,000 annual gifting, 2 policies, $119,000 times for 9 years, or one survivorship, $109,000 for 6 years. The survivorship policy is going to be $419,000 less. So that's neat, except we know that they may have to wait a longer period of time to get it. Now, who should own the policy? And I'm going to go through this fairly quickly because there's a lot of details here, but who should own the policy? Maybe it's an ILIT, or maybe it's the kids. ILIT stands for Irrevocable Life Insurance Trust. So while Art and Judy are alive, the trust is going to own the policy, but it's separate from the insured. So the policy is removed from their taxable estate. An attorney sets up the trust. The trust is the owner and the beneficiary. Every year, Art and Judy gift premiums into the trust. The trust sends out crummy letters, which trusts have to do to convert the gifts from a future value to a present value. And then the trustee pays the premiums into the life insurance policy. That's in life. At death, the death benefit is not included in their taxable estate because it's owned by the ILIT. The ILIT even has its own tax ID number. So it's estate tax-free and income tax-free. The trust is the beneficiary, so the death benefit isn't paid to the kids, it's paid to the trust. And the trustee disperses the life insurance proceeds to the beneficiaries through the trust provisions. So that's a plus to an ILIT, is that mom and dad can control from beyond the grave. It protects spendthrifts who might use their $500,000 and go to Vegas, protects minor children, or Art and Judy just might be type A's who really just want to keep ruling, running things. And a plus is, again, that the death benefit is removed from the taxable estate. Even if they don't have an estate tax issue today, things can change, so it's completely removed, and then those gifts that they made also are out of the estate now. Downside, well, there's attorney fees to getting it set up. Do you have a good trustee? If the trustee's 20 years older than Art and Judy, probably not going to be around when Art and Judy need to pass on the life insurance. So should have a good trustee. And, again, If they don't own it themselves, once they gift it, they're going to lose some control. You have a poor man's ILIT. So as an alternative to having a trust set up, the children apply for the life insurance policy on the parents. Parents gift the premiums to the adult children instead of gifting it to the trust. The kids own the policies on the parents instead of the trust. The premiums are gifted out of the estate either way. The death benefit is never in the parent's estate either way. So very, very similar in that the kids own the policies, the ILIT owns the policies, there will be all of it's removed from their taxable estate, and in my scenario, they're using their annual gifts to be able to do that. But remember, again, once you give it away, it's gone. Now, a downside to having the kids be the owners of the policies is that the kids are the beneficiaries of the policies. If the kids are not good with money, they're going to get that $500,000 completely unfettered. They're going to name themselves the beneficiaries. They're going to do whatever they want with that. So if the kids own the policies, then mom and dad and Art and Judy are giving up some control on what they're going to do with those proceeds when they pass on. The question, will this webinar recording be available following the webinar? Yes, it'll be up on the website and sometime this week. So who's going to benefit from the life insurance policy? Well, normally it's the beneficiary. You know what? The insured usually doesn't get anything from the life insurance because, well, they're the insured and they're dead. So if the life insurance pays out, they're not really around to enjoy it. The insured may be able to take out loans or withdrawals out of the cash value if there are any. And like we said, with term, there's none. So may be able to access some cash value. But now, in the last number of years, insurance companies have designed hybrid policies, life insurance policies with long-term care riders. So the insured can actually access the death benefit of the policy to pay for long-term care needs. Why? Why are we looking at that? Well, majority of people over age 65 will eventually need help with certain daily living tasks like bathing, eating, or dressing. Men are going to need average assistance for 2.2 years, women about 3.7 years. 1/3 of people over age 65 will eventually spend some time in a nursing home. Now, it can be short, it can be long, but the average annual cost is $100,000. 4 out of 10 people who need care, though, will opt for paid care at home with an average cost of about $50,000 a year. So these are not small numbers here. Half of the people over age 65 who will incur long-term care, half of people over age 65 will incur long-term care costs, and 15% of those are going to end up paying more than $250,000. So again, these are real numbers. So let's look at a life long-term care example. Going with my theme of rockers and musicians, Who's That Girl? Anybody remember the Madonna Who's That Girl movie from probably late 80s? Probably dating myself there. Never mind. But let's pretend that Madonna is now age 65. I think she's actually 62 or 63. But if she was 65 and had 3 Prudential whole life policies, she might meet with you and say, you know what, I don't really need life insurance anymore. Death benefit is not an issue. And so I have minimal life insurance needs. I'm worried about how to pay for care should something happen to me. I have enough money. I did pretty good with that whole singing thing. But I've got this money in this old policy, 3 old policies, and I'm just not excited about the whole lifeness of it. How do we do something else with it? Well, we can look at 2 different types of hybrid plans. There's a life insurance primary design, so it's going to have more life insurance, but usually the long-term care benefit is at sort of a fixed 2% of the life insurance amount. So if it's a $250,000 policy, want to accelerate the policy for long-term care, then you can draw down on the policy at 2% of that face amount every month, $5,000 a month for up to 50 months, and then it's used up. Or you can look at a policy where the long-term care is the primary driver. These are going to have very small life insurance amounts, but you can design a 3, 4, 5, 6-year benefit period. You can add an inflation rider. So you're going to have a large long-term care pool and a small death benefit. So I thought Madonna's name might be different, so I was going to use her real name, but it turns out her actual first name is Madonna. So we're going to maximize the long-term care benefits for her. Using a 4-year benefit period, 3% automatic compound inflation rider, using the same cash value rollover from all of those policies. 3 policies, the hybrid plans, they're all kind of the same, all a little different. What's important, and I think that's a key to figuring out what's some of the differences. With the Securian or Minnesota Life policy, it says you can get 100% of your money back after the first 5 years. The other 2, it's got a lower amount than what they paid in. Elimination period, the Lincoln National policy is a 0-day elimination period. They all have the same death benefit, which is basically the cash values. So knowing that if something happens and Madonna never needs the long-term care benefits, we know her beneficiaries are going to get back at least what she paid in. A residual death benefit. If she uses $100,000 of long-term care benefits, so more than that death benefit, there's a residual death benefit that is paid regardless of how much long-term care she uses. So that's an amount that will go to somebody regardless. And then we look at the long-term care benefits. What are the monthly benefits? What's that pool of benefits going to be in 20 years? And how is Madonna going to receive those benefits? Is it going to be a reimbursement design where she submits costs of care every month and gets a check for being reimbursed? Or is it an indemnity? And indemnity, once you qualify for benefits, you just get a check for the monthly benefits. So it's a little more, it's a little less restrictive on how you use the benefits every month. But I mentioned it, they're all kind of similar. They all had a 4-year benefit period. They all had a 3% inflation rider. They all had some cash value. They all had some residual benefit. So they're all, how do we consider these? Well, what's important? No elimination periods. Is the idea of that cash value sitting there important? I think for some people it is. Even if they never do anything with it, they like the idea of, I put this money in, and at any point, if I decide I want to walk away, I'll get my money back. And I think just that sleep at night factor, that peace of mind is important for some people. Or maximize the long-term care benefits. We know exactly what it's for. Clients are never going to, Madonna's never going to use that $65,000, so we want to maximize the long-term care benefits to provide care just in case we have that sort of catastrophic event. So we touched on term insurance, permanent insurance, hybrid policies. But before we go, I want to just give a few sort of COVID updates. Things have been in a big change the last 6 months. So initially, long-term care. Mutual of Omaha, a number of months ago, said we're going to stop issuing policies or stop offering policies to anyone over age 65. We just don't know how all of this is going to play out, and so we're going to pause on this. Over time, they've loosened that restriction, and I think have had 3 or 4 different changes where they added back in certain states. And I think up until about a week or 2 ago, they were issuing over age 65 in all states except Washington, Oregon, and California. And sometime in the last week or 2, Mutual of Omaha will accept applications for people over age 65 in all states. So that's a great change. Travel. Again, as insurance company underwriters get more used to this, whatever we're living in, if you want to call it the new normal or you just want to call it today, or today, which looked like a lot like yesterday, which is going to look a lot like tomorrow, they're relaxing certain things. Travel is a big one. Most insurance companies, especially life insurance, had a rule that said if you had any foreign travel planned, we will not consider you until you've returned and have no future plans. Plans, and we tell clients and advisors this all the time. Plans are, I have a hotel room booked, I have a plane reservation, not we'd like to go to Italy sometime in the spring, assuming things loosen up. So that's not really a plan. A plan is booked. And so a lot of companies, insurance companies, especially with the life insurance, said, if you have any plans, we're not going to offer coverage until you've returned and don't have any future plans. Lincoln, as an example, in the last few weeks, loosened up their restrictions and said, that is not an issue anymore. Now, we're going to still look at travel restrictions to places like Iran and Iraq, but at least from what I can tell, to them, traveling to England is not any more risky as far as COVID goes than getting on a plane and going to somewhere else in the US, to going from the East Coast to West Coast. So they've relaxed that restriction. And so again, those are, anytime we relax those restrictions, that's good for your clients. Going digital. A lot of insurance companies have moved from a traditional way of requesting medical records and getting medical records for your clients to one that's called Human API, and they seem to be the number one player out there. And essentially what they do is the Human API interface creates a link between, your client creates a link between their online medical records with their doctor and the insurance company underwriter. So that instead of waiting weeks for different copy services and people to request records and send records, the client creates this link that says, logs into Dr. Smith's portal, and the insurance company underwriter can look at Dr. Smith's records right there on their portal. So it can, save, I said days or weeks, I'm easily weeks, not sometimes a month or more. So just something really neat in that area. Another way of going digital, a lot of companies are using express applications to try to get clients through the application process, maybe without having to order those medical records, without having to order an exam. And so they're trying to use as much data online as possible without having to do those invasive tests. And a lot of companies use an express application where we give them some information about the client, and then the client has a telephone interview with a paramed provider or the insurance company to go through the health questions. A lot of companies have now added the option to answer all those health questions digitally. So that's a nice option. The telephone calls, if a person in front of somebody went long on their telephone interview, then the person behind them sometimes had to wait a little longer and be on hold. It's, again, it's a less than perfect process of trying to guess how long each of those calls will be when you try to schedule something. So it's a neat way to be able to have the clients fill it out online. That way they can do it at night. They aren't constrained by normal calling hours, do it on the weekends, what have you. So it's just a nice additional way of being able to get clients through the application process faster. And if anyone has seen on our website and or read anything, EMSI was a number one provider or a primary provider of some of the exams and these telephone interviews, and they shut down early July. And so there were times where some of those calls had to be shifted to another provider. This way, going online, not relying on that. So some really interesting things, at least in the insurance world, because the insurance world usually moves very, very slowly, and we're seeing some of these things happen, I think, very quickly. I know I've seen things where originally insurance companies thought it might be rolled out first quarter of next year, and they've already launched it because they're trying to accelerate these things with the current environment. So thank you all for listening. It was a lot of fun. We'll do this again next month with the life insurance part 2. Join us at any of the virtual conferences. They're all virtual the rest of the year, the ones that we'll be attending. So the XYPN Live-ish, NAPFA Fall, and the ACP conferences all in October this year. For those of you who are new to us or new to our webinars, I always go through my David Letterman's top 10. So top 10 things that make us different. These free monthly webinars for advisors. You get your CFP, CE credits, and then hopefully you take some tips or ideas away from all of this to help work with your clients. We're not your competition. We don't do what you do. Our only clients are fee-only advisors, so our goal is to work with you, find the best fit, find ways to save you time, save your clients money. We do a lot of pre-underwriting to avoid surprises, getting a lot of health questions and details from clients up front to find that best fit, so that we spend a little more time on the front end than a lot of people might to minimize for time during the underwriting process and having things pop up that we didn't know about. A lot of tools on our website, proud sponsors of a number of different fee-only organizations. We have specialists in the life, disability, long-term care, annuity, and hybrids, like the life long-term care hybrid policy I talked about. And we're here for the long term. So we help you manage your clients' policies now and in the future. We have our advanced premium emails to let your clients know that they have premiums coming due and to be on the lookout for that from the insurance company. We let you know and the clients know if their term policy is expiring, and with plenty of time to make changes if they need a new term policy, if they need to convert that term policy to permanent because their health has changed, or just enough time to say, Mark, we're like Uncle Pennybags. We got to retirement. We got to financial independence. We're all set. And we have Alice, our advisor portal, where you can see lots of information about your clients. There's reports there for your clients. You can see status updates on any of their quotes or applications through us. So a lot of good information there that's available for you to help with your clients. I already had some questions, and then the phone says I went 2 minutes over time. So does anybody else have any other questions? All right, well, not seeing any at the moment. Thank you, everybody. And it was fun to talk to you all. Have a great rest of your week, a great rest of your month, and we'll do this again in October. Thanks.